Risk management is a crucial aspect of trading that is often overlooked by beginner traders. However, understanding the importance of properly managing risk in trading is crucial to protecting your investments and maximizing long-term success. One of the key elements of risk management is capital protection. It is essential to set reasonable loss limits for each trade and ensure you adhere to them. This allows you to limit losses in case of adverse market movements and preserve your capital for future trading opportunities. Capital protection is vital for sustaining your trading business in the long run. Proper risk management also helps reduce emotions and their negative impact on your trading decisions. By being disciplined in applying risk management strategies, you can make rational decisions and avoid being swayed by emotions such as fear or greed, which often lead to irrational choices. Risk management allows for a more calculated and objective approach to trading. Diversification of your portfolio is another important aspect of risk management. Instead of putting all your investments in one basket, it is crucial to diversify across various financial instruments, sectors, or markets. This way, if one trade or sector incurs losses, you will have other investments that can offset the losses and reduce the overall impact on your portfolio. Diversification is one of the key principles of risk management. Utilizing tools such as stop-loss and take-profit orders is essential for effective risk management. Stop-loss orders allow you to set a maximum loss limit for a trade, while take-profit orders enable you to set a profit target. These tools help limit losses and protect your profits by ensuring an automatic exit from the position when the price reaches certain levels. Consistently setting and adhering to these orders is crucial for effective risk management. Constant monitoring of your investments and market conditions is a fundamental aspect of risk management. Staying updated on news and events that can influence financial markets and regularly evaluating your trading strategies allows you to make informed decisions and adapt to changing market conditions to protect your investments. Properly calculating the risk and determining the size of positions is crucial for risk management. This involves identifying your stop-loss level, calculating the risk associated with a trade, determining the risk percentage per trade, and calculating the position size accordingly. Adhering to appropriate position sizing helps manage risk effectively and avoid significant losses. In conclusion, risk management plays a vital role in trading by protecting your capital, reducing emotions, diversifying your portfolio, and allowing for rational trading decisions. By utilizing tools such as stop-loss and take-profit orders, diversifying your investments, and practicing constant monitoring and appropriate position sizing, you can effectively manage risk and increase your chances of long-term success in trading.